If you click this video, something probably happened recently. Maybe you just wrote a big check to the IRS that you felt you shouldn't have. Maybe you were talking to another business owner and they mentioned a tax strategy or a move they made and you didn't know what it was and you didn't know if it applied to you. Or maybe you just asked your CPA that exact question. And for the 10th time now, they still haven't gotten back to you and probably won't for another couple of days. Whatever it was, you're sitting with this feeling, thinking, is there someone actually looking out for me here? Or am I just getting billed and left alone? And the honest answer is that's probably what's happening. And it's not because your CPA is doing anything wrong, they're keeping you compliant and safe, but because there's a version of this that helps your business and there's a version that doesn't. And most business owners I talk to doing 500K to over $1 million a year, they've never had anyone show them this difference. So today, I'm going to show you that difference by giving you a self-audit checklist. These are 5 indicators that are going to tell you right now whether you're overpaying taxes, even if you don't realize it. And if 3 or more of these apply to you, then you'll know for sure. So real quick, before we get into the checklist, I put together a free CPA scorecard. The link is going to be in the description. I really recommend you use this, especially with what I'm covering in this video. It's going to give you a list of specific questions you can ask your CPA or accounting firm and a rubric to grade how much they're actually helping you versus how much you think they're helping you. The link is going to be in the description for that. And now let's get into the video. Okay, so how do you know if you're overpaying taxes? Like actually know, even when you don't realize it, but you just think that you are and you suspect it. These are going to be 5 indicators that are going to tell you exactly if that's the case. And I'm just going to walk through each one, break it down for you. So the first indicator is no quarterly tax projections. So this is the single biggest indicator, and I put it first for a good reason. Not everybody gets this, but most should. So a tax projection is just taking what your actual year-to-date numbers are, your revenue, your expenses, owner's comp, estimated payments, and it models out what you're going to owe for the full year based on where you're trending. And that's the key word, where you're trending. It's so that you can do something to lower it before the bill hits. You know what it's going to be before year end, so you can make some moves before that happens so you don't pay that full amount. But here's the problem that I see happening a lot is that this should happen every quarter. Yet I get on calls with clients and I hear people getting this only 1 time per year, maybe 2 times per year, but that's not the right way to do this because that's just a static projection. See, your business is going to change throughout the whole year, especially if you're really fast growing, putting a lot of money into marketing, you're growing your team. The tax position is going to fluctuate constantly throughout the year. So you can't be relying on a static projection that somebody did at the beginning of the year when maybe in October, November, you're in a completely different position. It just wouldn't make any more sense. So here's what it should actually look like if you're doing this correctly. So in Q1, you're setting the baseline. You're looking at last year's numbers and you're looking at what the year is tracking going forward. What's your goals? What are your targets that you're planning to hit this year? In Q2, you're doing a mid-year review. You're checking on Q1. How is the year going so far? Is revenue currently ahead of schedule? Is it behind schedule? Maybe you made a few growth investments during this time that we hadn't discussed before. So now you start to adjust the plan if you need to. In Q3, you're making more tax moves. If you're trending toward a bigger bill than expected, then this is where you can start to pull the levers that are going to lower the tax bill. Accelerating depreciation, accelerating expenses, adjust your salary, make retirement contributions, all kinds of different tax strategies. You can start to do them in Q3. And Q4 is when you lock in those savings. This is those last minute year-end strategies. So from Q1 to Q3, all those projections that are happening throughout that time, any additional moves needed happen here. Now, the mistake that happens is most people are discovering for the very first time, what moves can I make? That is not what Q4 is meant for. If you're doing that, then it means that those strategies might not go into place. It might have had to have happened months earlier in the year for them to go into place. And you're probably not getting even the full picture because you're probably rushing and you don't have a proper plan in place. So this is what an actual quarterly tax projections calendar could look like for you. And if no one is running these for you, especially at this rate, and then you're making every financial decision in your business, whether it's hiring, buying things, taking distributions, with zero idea how it's going to hit your tax bill. And if you're doing over 7 figures, you don't want to be guessing on this at all. The more you guess, the more likely it is that you're going to overpay in anything and more likely you're going to lose money. And we don't want to lose money here. So if this is happening in your business right now, I want you to check this box. And for each of these, check the box and then come back to it at the end where I'm going to have a scoring grade rubric for you. So the second indicator is no entity review in the past 3 years. So think about how much has your business changed in 3 years? Hopefully a lot. So your revenue might have doubled. You might have added a business partner. You might have expanded to new states if you have a lot of physical locations. You might have started a second business, maybe even a third business. You might have bought a real estate property or invested in other assets that are growing your net worth. All awesome things that are going to happen as you grow the business and you make more money. But you might still be operating under the entity structure that you set up on LegalZoom many years ago when you were doing 200,000 a year. Your entity is going to be the foundation of the entire tax strategy. If it's wrong, everything built on top of it is also going to be wrong, from not just a tax position, but a legal position as well. You could be putting assets at risk if they're not under a correct entity structure. And at 7+ figures, the difference between a poorly structured LLC and a properly optimized S Corp with a holding company, operating company can easily be 6+ figures in taxes. And it's not an exaggeration. I've seen that before. And if no one has looked at your structure and said to you very recently, within the past year, I'd say, is this still the right setup for where you're at today? If they didn't, I want you to check this box as well. So the third indicator is no quarterly strategy calls. And this is different from indicator one. So projections, which I had talked about before, are about the numbers. Where are we trending just on a number basis? Strategy calls are where the actual decisions are being made. So this is where your advisor asks and starts to implement based on these questions. What's going on lately? Any things coming up to anticipate? Revenue up, down? Any new goals to add? Any big moves that you're making? Are you hiring more people? Are you thinking about buying a building, bringing on a partner, investing in more assets, whatever it is? Any big moves I should know about? Any adjustments needed? Are you landing bigger contracts? AKA, are you making more money than what we thought before equals higher tax bill? Are you investing more into paid ads than discussed? AKA, are you growing faster than we planned? Let's do some things now so that we can mitigate a future tax bill. Every single one of these decisions here has a tax consequence. And if you make the decision first and then you tell your advisor after, you may make a decision you don't like. It may grow your net worth by a lot if you invest into certain things, but you might get hit with a lot bigger tax bill at the end of the year, depending on what you're doing. And you might not want that. So it's best to have them help you make decisions on a quarterly strategy call like that. And if the only time you hear from your accountant is in March when they need your documents to file your taxes, that is tax compliance and not tax planning, what we are discussing here. They are filing what already happened. They're not shaping what is about to happen. Now, you still need the filing to stay compliant, not go to jail, and not get hit with penalties. But there's another piece to this, especially as you're scaling, where it becomes super important for you to start doing. So if you don't have those regular strategic conversations, sometimes even needing monthly ones, depending on how fast you're growing with someone about your tax or financial situation, check this box as well. So the fourth indicator is that you've never seen a comparison. You have never seen a side-by-side comparison of what you're currently paying in taxes versus what you could be paying. This is the one mistake and one thing that when I show it to people, it makes them sick to their stomach because they realize how much money that they're wasting and losing every single year. Until someone shows you that gap, you don't even know it exists. But once you see it, you can't unsee it, and it makes you want to do something about it. So as an example, you have your before picture where you're at right now, your real numbers for revenue, profit, owner's comp, entity structure. You're likely going to pay a large tax bill on that. Then after, you have an optimized tax bill. What would that look like when you have an optimized entity, owner's comp, asset strategies, tax strategies? And then you can make the comparison between the tax bill in that situation versus before. And it's likely going to be a good amount of money. So if nobody has ever done this before, you have no baseline. You can't optimize what you're not measuring. How do you truly know that you're overpaying until you compare it versus an optimized scenario? You're just trusting the number on your return as the best that it could be. And I can tell you now from doing 10 plus audits with 6 and 7 figure businesses recently, it almost never is that way. So if you've never seen this comparison side by side, I want you to check this box as well. Now, the last indicator is you don't know your effective tax rate. So, this is a very simple formula, but most people cannot tell me the answer to this. So, the effective tax rate is equal to total taxes you paid divided by your total income. It's the single most important number in your financial life, definitely your tax life. And most 7 figure business owners, they don't even know it. When I ask them this, they can't even tell me how much taxes they paid, let alone what their effective tax rate is. So, but they can tell me other things, other important KPIs to them, like cash collected, how many outreach messages did you send, how much money did you put into ads this month, what's your close rate on sales calls, what's your spend on payroll, software, rent. But when I ask them the percentage of their income that went to taxes last year, it's not even taken into consideration or not even seen to be a big deal. Or maybe it's just something that they didn't realize was important for them to start tracking. I'd argue that this is a top 5 financial KPI to start tracking. Do this going forward. If you take one thing from this video, start tracking this, because if you don't know your effective rate, you can't benchmark it. You can't tell if it's too high. You can't track whether it's going up or down each year, and you definitely can't set a goal to lower it. So if you really want to pay less taxes, like anything else, you need to track KPIs, and this is one of the most important ones. At 7 figures, a healthy effective rate, in my opinion, with proper planning, is going to be between 20 and 25%. It can go lower if you go more aggressive with strategies, but this is pretty conservative. If you do the math and you find that it's 33% or higher, like a lot of people's is, it's worth looking into, but you're not going to know unless you know the number. Once you know the number, then you know what you need to attack and what you need to lower. If you don't know your number right now, if you can't tell me off the top of your head, what's your effective tax rate, check this box as well. All right. So how'd you do? How many did you check? So this is just a simple grading rubric that I have here based on your answer. So if you only had one or two of these indicators that you're not doing at the current moment, I'd say you're in a good position. You've got some gaps, but you're not in terrible shape. You can tighten up some of those areas, and then you'll see an immediate improvement and you'll be at 100% perfect. Now, the caution area is if you checked off 3 or 4 that you're not doing. This is the caution area because you're likely overpaying here. And I could say that with confidence. We're talking 5 to 6 figures over the last few years that you probably didn't need to give away. And if all 5 of these, for some reason, if you're at high 6, and especially at 7 figures, all 5 of these you're not doing right now in your business, you need a proper tax strategy in place today. You are bleeding money every single year. And the longer you wait, the more it compounds. It could compound into hundreds of thousands of dollars within the next few years if you keep it up, especially if you're scaling as well. This is something you really need to look at if all 5 of these you're not doing. So here's what I tell you to do right now. First, go grab that CPA scorecard in the description and use it to evaluate whether your current CPA or firm is actually the right fit for your businesses today. I've shown you a couple indicators right now, and it's going to show you a good idea of if you're trending in the right or wrong direction with your advisor, but that scorecard is really going to tell you, and it's going to give you a true grade for your specific situation. So go grab that. Link is in the description. If you checked 3 or more of these boxes and you want someone to actually look at your numbers and run that comparison and show you how you can improve that number, that's exactly what we do at my firm. There's a link in the description for that as well to book a call with my team. What we'll do is we'll look at your situation, tell you what we see, and if there's a real opportunity to save you money, I'll explain exactly how. And if there's not, we'll also tell you that too. If there's not a good ROI on this, or we don't think you're going to get a lot of benefits, we won't even offer to work with you because it just won't make any sense. So either way, I want you to just stop guessing. I want you to get clarity on your numbers and start knowing what you need to benchmark. That's one of the key things that we went over in this video. You didn't build that 6 or 7+ figure business by hoping things would just magically work out. You had a plan and you executed it. don't manage your taxes the same way where you have no plan and you're just winging it. That's just a recipe for losing a lot of money over time. And if you like that one, I have plenty more videos on the channel. I'll see you in the next one. And if any of this hits home, send it to another business owner who needs to hear this and might need some help.